Emotional decision-making, how to keep your cool while investing. Investing is one of the smartest ways to build wealth and achieve long-term financial freedom. However, it also comes with emotional challenges that can steer even the most disciplined investors off course. For young professionals, navigating these emotions, be it fear, excitement, or anxiety, can make all the difference between success and regret. In this video, we'll explore how to keep your cool in the world of investing. You'll learn about why emotions impact investments, how to recognize and manage your triggers, and practical strategies to stay resilient through market ups and downs. Let's dive in. Investing may seem like a numbers game, but it's deeply connected to our emotions. Let's explore why they play such a big role. When the market is soaring, it's easy to feel euphoric and tempted to take bigger risks. Similarly, during a downturn, fear can dominate, triggering panic selling or hasty decisions. Both extremes, however, can derail a carefully planned investment strategy. The problem lies in human psychology. Behavioral biases like loss aversion make it hard to stay rational. Research shows that losses feel more painful than equivalent gains bring joy. This fear of losing money can push people into selling at the worst possible moment. On the flip side, the thrill of chasing high returns can lead to overconfidence, causing overinvesting in risky assets or following hype trends. Understanding these emotions is the first step to controlling them. By recognizing why you react a certain way, you can pause and make better decisions. What exactly brings out these emotional reactions? Here are some common triggers you might face. Market volatility. Seeing your portfolio value drop during a market downturn can feel like a massive loss, even if it's temporary. This often leads to panic selling. Overhyped news. Reading about a rapidly growing stock or booming industry can create fear of missing out, FOMO, and push you to make impulsive purchases without enough research. Pressure from others. Friends, family, or social media may exaggerate the potential of certain investments, making you question your own plan. Underperformance. Seeing others outperform you financially can lead to feelings of inadequacy and cause rash decisions to catch up. By identifying these triggers, you can train yourself to pause instead of reacting impulsively. Managing emotions while investing doesn't mean you ignore them. It means you learn to channel them productively. Emotional resilience is a skill that allows you to withstand the market's highs and lows while staying aligned with your long-term goals. Take successful investors, for example. Their secret isn't that they're smarter than others. It's their ability to stay calm during market panic or euphoria. They rely on data and plans, not emotions, to guide their decisions. As a young professional, developing emotional resilience doesn't just improve your performance as an investor. It sets the foundation for lifelong habits in financial management. Resilience means learning to look past short-term noise and trusting the process, even when it feels unnerving. Now that you understand the role emotions play in investing, let's dive into practical steps to control them. These strategies will help you manage your reactions and make more informed decisions. The first step to staying focused is understanding why you're investing. Are you saving for retirement? Building a down payment for a house? When you have clearly defined objectives, it's easier to tune out market fluctuations and stick to your plans. Write down your goals and remember, investing is a marathon, not a sprint. Short-term emotional reactions won't help you reach your destination. Diversification involves spreading your investments across various assets, such as stocks, bonds, and commodities. This reduces your overall risk. For example, if one sector drops in value, others might perform well and keep your portfolio steady. When you know your portfolio is diversified, it's easier to stay calm during market dips because you won't feel like your financial future rests on a single investment. An investment plan is like a financial roadmap that includes details about your goals, risk tolerance, and strategy. Once your plan is in place, treat it as your guide, especially during turbulent times. Your plan will help you avoid impulsive reactions. For instance, instead of selling during a dip, consult your plan and remind yourself it's designed with long-term success in mind. Reacting quickly during market news can often lead to emotional decisions. Instead, adopt a cooling-off period. Give yourself 24 to 48 hours before making major changes to your investments. This simple habit can prevent snap decisions based on fear or excitement. History often shows us the resilience of markets. For example, while financial crises like the 2008 recession caused massive losses, markets have recovered and continued growing in subsequent years. Revisiting historical trends can reassure you that downturns are temporary and long-term investing wins. One way to reduce emotional interference is by automating your investments. Techniques like dollar cost averaging, where you invest a fixed amount regularly regardless of market conditions, help you stay consistent without second-guessing every market move. Managing risk is not just about crunching numbers. It's also a defense against emotional reactions. Risk management helps set realistic expectations and keeps your emotions in check. Here's how. Understand your risk. Tolerance. Knowing how much risk you're comfortable with makes it easier to choose the right investment strategy. A high-risk investor might hold more stocks, while a conservative one may prefer bonds or stable assets. Build an emergency fund. Having an emergency fund ensures you won't have to dip into investments for unexpected expenses. This safety net reduces stress, allowing you to stick with your plan during market turbulence. Risk management acts as a shield, ensuring you're prepared for financial challenges without derailing your goals. Consistency builds wealth over time. Whether it's contributing monthly to your retirement account or staying invested during market downturns, discipline is key. Take dollar cost averaging as an example. By investing a fixed amount regularly, you buy more shares when prices are low and fewer when prices are high. This minimizes the impact of market volatility and removes the guesswork of timing the market. While consistency sounds simple in theory, it takes emotional control to maintain during adversity. That's why it's vital to focus on long-term results rather than reacting to short-term fluctuations. Young professionals today have access to countless tools to create smarter, emotion-free investment strategies. Investment apps. Automate your contributions using platforms that rebalance your portfolio regularly and follow your set plans. Research and education. Understanding the market and how it operates can reduce the uncertainties that trigger fear. Take advantage of educational materials, webinars, and financial advisors. Seek mentorship. Learn from others' experiences. Surrounding yourself with knowledgeable investors or advisors can give you logical perspectives when emotions cloud your judgment. Technology and wisdom make investing more structured and less emotionally taxing. Use them to your advantage. Finally, let's talk about mindset. Investing is not just about numbers. It's about staying confident even when the road gets bumpy. Patience is your greatest ally. Recognize that short-term declines don't necessarily reflect long-term outcomes. Consider the S&P 500, which has consistently grown over decades despite recessions and crashes. When things don't go as planned, view setbacks as opportunities to learn. For example, reflect on what led to an emotional trade. Was it poor preparation or acting too quickly? Use these moments as lessons for improvement rather than reasons to give up. Keeping your cool while investing is about balancing emotions with clear strategies. By understanding your triggers, building resilience, and relying on long-term planning, you can avoid impulsive decisions and focus on meaningful financial growth. Remember, investing isn't just about growing money, it's about growing confidence in your ability to make smart choices. With discipline and the strategies we've explored today, any young professional can navigate the investing world with calm and control. Take a deep breath, trust your plan, and embrace the ups and downs. They're all part of a journey toward financial success. Let this be the start of a stronger, more resilient investing mindset.